The views and opinions expressed on this podcast are those of the guest speaker only and do not represent the views or opinions of NADA. NADA is not recommending that dealerships operate their businesses in any particular way. Each dealership must make its own independent business decisions regarding its business operations, including regarding its targets, if any, for inventory levels or gross profits. The information presented on this podcast is not intended in any way to encourage concerted action among dealerships regarding any aspect of their business operations.
Welcome to Dealer Driven, where the rubber meets the road to success. This episode sponsored by JGP Wealth Management.
You think long-term when you run a dealership. Reinsurance rewards the same discipline. Retain premiums, manage risk, build capital. Reinsurance for dealers who play the long game. JGP Reinsurance Alpha.
Welcome to Dealer Driven. I'm Michael Hayes.
And I'm Cameron Wilson. Today we're talking about something every dealer is feeling in real time. How do you make the right decisions in a market that keeps changing around you? From shifting inventory levels to evolving consumer expectations and the recent FTC actions, the old playbook just doesn't hold up the way it used to.
Joining us today is someone who spent decades helping dealers navigate exactly that kind of complexity. Dale Pollak is the founder of vAuto and the creator of the Velocity method of management, as well as the champion of investment management, which has transformed how dealers think about pricing, inventory, and performance.
We'll talk about the biggest mistakes dealers are still making, how to read the signals of a changing market, and where the real opportunities are hiding right now.
Let's get started.
Dale, welcome to the show. We're so happy to have you.
Thanks, Cameron, and thanks, Michael. It's an honor to be with you.
So, Dale, you've been advising dealers for decades. I know I'm not making you sound that old, but, what's the biggest mistake you're still seeing dealers make today, even with all the experience we have in the industry?
I think one of the bigger mistakes that dealers make is getting trapped in that thought process that they chase volume by increasing their inventory. And let me explain why that is really a problem. If we just go back approximately 10 years, the average used vehicle investment was about $14,000, and the average front-end gross profit, give or take, was about $1,500. Well, fast forward to today, 10 years later, the average used vehicle investment is more in the area of $28,000, and the average front-end gross profit is still about $1,500. Think about what that means. 10 years ago, the annualized ROI, if you invested $14,000 and you made $1,500 in 45 days, the annualized ROI was about 96% roughly. And now that we have to invest roughly twice the money to make about the same front end, essentially the ROI is in half. It's like 43%. Now, think about what's going to happen in years to come. Is the vehicle going to get more expensive? Of course it is. And is the profit going to rise? Probably not. If anything, it's likely to go down. So what's happened is that we've seen an erosion of the return on investment of these vehicles. So if you're in an environment where you're investing in assets that have a decreasing ROI, does it really make sense to invest more capital to chase volume? And I would say that the wiser approach would likely be to get more return out of the vehicle investments you have, rather to throw more money at ever decreasing ROI investments. So I would say that I understand dealers always want more volume, but there's more volume to be gotten more profitably by getting more out of the vehicles that you are invested in rather than investing in more vehicles.
So along that same line then, Dale, and this is obviously something that you spend a lot of time talking about now the last 5 or 6 years, is how do we think differently about inventory aging compared to pre-pandemic or pre-2016, 17 even in your thought process?
Right. So traditional wisdom in the car business is that there should be an age limit. And why do we know that there should be an age limit? Because we know that over the period of time that we hold the vehicle, what we own it for really doesn't change. But what does change a little bit every day is its market value. And it goes down generally over time. So the key here is not to stock cars that lose their ability to achieve a net profit. And the reality is that traditional wisdom would say we should have a certain days, certain age limit, whether, it be 45 or 60 or 90, but that presumes something that's not true. That presumes that every vehicle holds the same level of risk and opportunity. And that's simply not the case. There are some vehicles that hold their ability to make a net profit longer, and there's others that have an ability to lose money sooner. So having a static age policy, whatever it is, 60, 90, 45 days, just doesn't make sense because it assumes that every vehicle has the same level of risk and opportunities. So therefore, if you accept the premise that each vehicle on the lot holds its own unique profile of risk and opportunity, it makes sense to have an age policy for each vehicle that's appropriate for its potential. So I believe that there are some vehicles that should have an age policy, let's say that they are gone in 15 days, and other vehicles perhaps deserve more than 60. Maybe they deserve 70, 80, and potentially 90 days. Some should be gone sooner, and some should be given a chance to achieve their potential, even if it takes more than 30 days.
Interesting. So, what signals should dealers watch to avoid being caught on the wrong side of the next market shift?
Yeah, good question. So knowing that the market is so volatile because things in the world are, happening at a pace that is very fast and hard to predict, I believe strongly that a really important key metric of used vehicle management is every single day to keep track of your dealership's rolling 30-day used car sales total. Let me repeat that. Your dealership's rolling 30-day used car sales total. How do we calculate that? It's simple. We just count back 30 days. How many used cars did we sell and deliver? Tomorrow we'll drop off the 31st day and we'll add today. Hence a rolling 30-day used car sales total. And the reason that that number should be known every single day is because you should compare that number every single day to the number of units you have in stock. So if you have more vehicles in stock than your rolling 30-day sales total, you should really draw back on your buying. Now, of course, you're going to trade for cars. You don't want to slow that down, but you should not be buying more cars because you already have more than a 30-day supply. If, on the other hand, your rolling 30-day sales total exceeds your current inventory, then you earn the right to go out and acquire some additional cars, but only the number of cars that would create a balance between your rolling 30-day sales total and your current inventory.
Terrific. So, Dale, when we think about this, and I hear you talk a lot about the market, the rational market and everything. So I think everybody agrees customers are more educated, maybe a little more skeptical sometimes. And Karen mentioned the FTC, but how should that change how dealers price and present vehicles, in their marketing, advertising?
Right. One of the things that we've learned from the investment management approach, as I said a few moments ago, is that there are some vehicles that hold greater potential than others. And what largely defines the risk or opportunity profile of a vehicle is a proper weighting of three factors. It's how the dealer owns the vehicle, measured by their cost to market, number one. Number two, the vehicle's market day supply. And number three, the vehicle's popularity in the market. So, as an example, if you have a vehicle that you own for a lot of money, maybe too much money, it's got low market day supply, and it's not a very popular car, I would say that that vehicle should be priced from day one very aggressively to move very quickly. But on the other hand, you're going to have some vehicles in your inventory that you own really right. You have a low cost to market. The vehicle has a low market day supply, and it's a high volume popular car. In that case, I would not be afraid of pricing that vehicle well above market because it's got all of the characteristics that will allow somebody or encourage somebody to pay more for that vehicle. So, not every vehicle should be priced consistent with how many days you've owned the vehicle. The vehicle should be priced based on the risk opportunity of the vehicle. Some vehicles deserve being priced for longer with a high gross profit. Other vehicles should be moved out very quickly for a low gross profit and potential and maybe even a loss.
You think long term when you run a dealership. Reinsurance rewards the same discipline. Retain premiums, manage risk, build capital. Reinsurance for dealers who play the long game. JGP Reinsurance Alpha.
So, where would you say that dealers are leaving the most money on the table right now, probably without even realizing it?
I think there are vehicles in dealers' inventory that they're pricing too aggressively, that if they asked for more money, they would find that they would get it and probably get it much quicker than they might think they would. So there are vehicles I think that we leave a lot of money on the table with.
So, of all the different departments in the dealership, Dale, growing up in a franchise store and everything else with your family, what drove you to become so invested, and no pun intended there, in the used vehicle side of the dealership throughout your career?
Well, that's an easy question for me because I think of all the departments of dealership, the used vehicle department is the one that really lends itself to the most amount of control. I mean, in all the other departments, I think the factors that lead to outcomes are less in control of management than in the used car department, often controlled by the factory, often controlled by things that are external, things that we don't control. But in the used car department, we decide what we stock, we decide what we pay for the vehicles, we decide what we ask for the vehicles, we decide how long we hold the vehicle. These are all factors that add up to success or failure, and they're all within our control. So I guess it's probably the fact that we can really control the outcome in the used car department more than any other department that has always attracted me to it.
So, you like being in control. That's what I just heard.
I guess maybe I've been told that before. Yes.
Maybe we should check with the family on that. Okay.
Yeah, nothing wrong with that. So, as a follow up to that, what was the impetus for your book writing habit?
I never thought that I'd write a book, and I wrote my first book, and it really had a lot to do with launching the company vAuto. And after I wrote the first book, I never believed that I would write another book. I've since have written 6 other books, and at the conclusion of every book, I swore to myself I'll never write another one. So what caused me to write all those books? I only wrote the books because I felt that there was some change in the market or some new observation or revelation that I had about the market that would really be a contribution to the industry if I did write it. So it's hard writing a book. It takes a lot of time. It's a very laborious process. And it's not one that's really enjoyable, at least not for me. But I've done it so many times just because the market has evolved and being a student of the market, I felt that it was a contribution that was important to make to do it.
Well, we really appreciate you sharing so many of your books with our students. That's very kind of you to do that, and they're wonderful education experiences to read those and then discuss thoughts and ideas because of that. So, thank you for the efforts you did to writing the book, even though it's not your most enjoyable function, as you just said.
Well, thank you. And I appreciate those comments.
So they're looking at today's market. Where do you see opportunities that a lot of dealers are maybe not getting full advantage of?
I really believe that dealers need to recognize that the old used car management playbook really needs to be revisited. The market has changed so fundamentally. The ROI on these vehicle investments, as I alluded to earlier, has eroded and will continue to erode. And as it does erode, I believe that it becomes ever more important for dealers to really realize that what's happening on that used vehicle lot is that we're managing money. Sure, we're managing merchandise, and to that extent, we do have to have and execute good merchandising skills, but at the most basic level, we're managing money. And I think that in an environment where the ROI is declining, I believe it becomes ever more important for us managing used vehicle operations to recognize that our first priority is to make decisions that are consistent with prudent money management principles. And these are principles that are not generally supported in the traditional used car management playbook. And hence, my most recent book called Invested, The New Science, Strategy, and Systems of Used Vehicle Investment Management really talks about principles of how we might rethink the used car management playbook to be more consistent with prudent financial investment management. And I believe that that represents the greatest opportunity for dealers to improve their business.
As a follow-up to that, how do we minimize suboptimal outcomes when investing in used vehicles?
To take what I call a variable management approach to managing vehicles. And when I say a variable management approach, what it doesn't mean is pricing every vehicle as competitively as possible, as quickly as possible for the sake of more turn, because every vehicle is different. And the analogy that I offer students in the NADA Academy is simply this. I ask them to consider, what does it mean to be a good parent? Does being a good parent mean you treat your kids all the same or you give them all the same things? I don't think so. I think what being a good parent means is recognizing that each child has their own unique strengths and weaknesses. And as such, the obligation to be a good parent is to provide that child what they need to achieve their greatest potential, whether it be large or small. Well, now that we have the benefit of some really good data science, what we can see on our used car lot, just like our children, is every one of them holds their own profile of strengths and weaknesses, largely defined by the vehicle's cost to market, its market day supply, and its popularity. And once we agree that every vehicle does hold its own unique profile of risk and opportunity, I think the smarter management strategy is to take a variable approach as to how we manage each vehicle, not say that we have the same age policy for all vehicles, not to say that we put all the same markup on every vehicle on day one, but rather look at each vehicle with its unique profile and take management action in terms of its priority of reconditioning, its pricing, its age policy for that vehicle, make it a variable strategy such that we give every vehicle the opportunity to achieve its greatest potential, whether it be large or small. Hence the strategy of variable management, which is the subject of my most recent book, Invested.
Well, thank you, Dale. As we wrap up, we always like to leave something for our listeners and everything else. But one of the things that, after listening to you several times in my life, what has to change in your mind so that the investment mindset of the managers of that asset we call pre-owned inventory in our store, whoever it may be, actually starts using and looking at the data to make these more optimal investment decisions? How do we physically get people to get out of, you said, of the traditional mindset that we have?
Good question, Michael. And as you've heard me say in my NADA class sessions, we should never expect anybody to change their thinking or behavior unless they understand why it makes sense. Why it makes sense, particularly when the change is hard. I don't think we can just say to our people one day, from this day forward, we're going to do things differently and expect it to happen. I think the only way that we can expect it to happen is if they understand why it makes sense. So, to that end, I find my opportunity to spend time with the students at NADA Academy and spend time with dealers out in the field to be very rewarding because it gives us the opportunity to help people understand why it makes sense to move to an investment minded approach, a variable management approach, if you will, to used car management. And why does it make sense? And most fundamentally, as I stated, because the ROI is eroded. And as the ROI of our vehicle investments erode, it becomes ever more important for us to make decisions and to manage our inventory first and foremost with prudent money management principles, not to ignore merchandising principles, but to recognize that our first order is to manage cash for the greatest possible return on investment. But that does require change in the old traditional management playbook. And these are changes that are not very familiar to dealers. So I think the most important thing to affect change is to have people understand why it makes sense. And that's why teaching at the NADA Academy has been such a privilege for me. That's why I wrote the most recent book, Invested, because it's an effort to have people understand why it makes sense to change. And at the core of it, it's because the basic fundamentals of the business have changed.
That's great. We talk about that a lot. The consequences of decisions we used to make are very different today than they used to be. Thank you very much for sharing that.
Absolutely. Dale, thank you so much for joining us today. And also thank you for all the time you spend with each of our Academy classes. We can't thank you enough.
Well, thank you. It's been one of the greatest privileges of my career spending time there. So thank you for that opportunity.
That's all the time we have for today's episode. A big thank you to Dale Pollak for joining us and sharing his perspective on how dealers can make smarter decisions, adapt to change, and uncover opportunities in today's market. I'm Michael Hayes.
And I'm Cameron Wilson. This has been Dealer Driven from NADA. Keep your dealership in drive, and we'll see you next time. The views and opinions expressed on this podcast are those of the guest speaker only and do not represent the views or opinions of NADA. NADA is not recommending that dealerships operate their businesses in any particular way. Each dealership must make its own independent business decisions regarding its business operations, including regarding its targets, if any, for inventory levels or gross profits. The information presented on this podcast is not intended in any way to encourage concerted action among dealerships regarding any aspect of their business operations.